A single apple can spark a thought. I'm Edwin.
What happens if U.S. Treasury bonds are no longer treated as the safest asset in the world? For decades, this question would have sounded almost impossible. U.S. Treasuries were seen as the foundation of the global financial system, the asset investors rushed into during a crisis. But recently, former U.S. Treasury Secretary Hank Paulson warned that policymakers should prepare for a possible collapse in demand for U.S. government debt. He used a powerful metaphor. Before America hits the debt wall, it needs an emergency break-glass plan. In simple terms, Paulson is warning about a scenario where the U.S. government needs to borrow more money, but investors are no longer willing to buy enough Treasury bonds. And if that happens, the Federal Reserve could become the buyer of last resort. That would be very different from the crisis of 2008. Back then, the U.S. government still had enough fiscal capacity to step in, issue debt, rescue the financial system, and restore confidence. But today, the situation is more complicated. U.S. public debt is much higher. Interest rates are no longer near zero, and global demand for U.S. debt can no longer be taken for granted. This is why the next major crisis may not look like the crises we have seen over the past 40 years. From the 1980s to around 2020, the U.S. economy operated in a long-term environment of falling Treasury yields. That usually meant falling inflation pressure, stronger demand for bonds, and a deflationary tendency during crises. In that world, when a crisis hit, investors sold risky assets and rushed into dollars and U.S. Treasuries. Stocks fell. Commodities fell. Risk assets collapsed. But Treasury bonds usually rose. That is what happened in 1987, in 2000, and especially in 2008. The dollar strengthened sharply, and almost everything priced in dollars came under pressure. That was the old crisis model: private sector deleveraging, deflation, and a flight to U.S. Treasuries. But the future may be different. If government debt is already extremely high, and if Treasury yields are rising instead of falling, then U.S. debt itself may start to look less like a risk-free asset and more like a risk asset. This changes the entire crisis mechanism. In a future crisis, some assets may still crash because of liquidity pressure, but other assets, especially those linked to hard money, energy, and real resources, may resist falling or even rise. Why? Because the problem would no longer be just private sector deleveraging. It would be a loss of confidence in government debt and ultimately in the currency system built on that debt. This is the key difference. In 2008, the U.S. government could use debt to solve a debt crisis in the private sector. But if the next crisis comes from the public debt system itself, then the government's ability to rescue the market becomes much more limited. Of course, in a deep crisis, the government cannot simply do nothing. If unemployment rises sharply and the economy contracts, policymakers will still be forced to respond. But if private investors are no longer willing to absorb enough Treasury issuance, then the Federal Reserve may have to step in more aggressively. That could mean more bond purchases, more liquidity creation, and potentially more pressure on the dollar's purchasing power. In that kind of environment, the crisis would not be purely deflationary. It could become a credit crisis of the dollar system itself. And this is why gold and silver become so important in this discussion. If investors begin to question the long-term credibility of government debt, gold may benefit as a neutral reserve asset. Silver may also benefit, especially if monetary demand and industrial demand strengthen at the same time. This does not mean gold and silver will rise in a straight line. There can still be sharp corrections. There can still be liquidity shocks. And in the short term, almost anything can be sold during panic. But if the deeper problem is confidence in sovereign debt, then gold and silver may enter a much stronger long-term phase. This is also why the current situation has some similarities with the 1970s, but with one major difference. In the 1970s, the U.S. also faced inflation, currency pressure, and a confidence problem after the breakdown of the Bretton Woods system. But government debt was much lower than it is today. Today, U.S. debt is far higher, and globalization is no longer expanding in the same way it did before. Supply chains are fragmenting, geopolitical tensions are rising, energy markets are becoming more unstable. All of these factors can put pressure on the supply side of the economy. And when supply becomes less stable, inflation becomes harder to control. That could make a future dollar credit crisis even more severe than the inflationary crisis of the 1970s. So, when will this happen? The honest answer is, no one knows. Paulson does not know. The Federal Reserve does not know. The market does not know. But the important point is not to predict the exact date. The important point is to understand the structure. For the past 40 years, crises were mostly deflationary. The dollar strengthened. Treasuries acted as safe assets, and the government could borrow to stabilize the system. But in the next major crisis, if Treasury demand weakens while government borrowing needs rise, the crisis could become very different. It could become a crisis of confidence in public debt. And if that happens, the traditional playbook may no longer work. That is why investors should pay close attention to Treasury yields, dollar liquidity, gold, silver, and the Federal Reserve's role in the bond market. Because the next crisis may not be another 2008. It may be something much more structural. And once the market realizes that U.S. Treasuries are no longer risk-free in the same way they used to be, the global financial system could enter a completely new phase. This video is not financial advice. It is a macroeconomic scenario analysis based on public information and current market risks. But one thing is clear. If the world's safest asset starts to lose its safe haven status, then everything else in the market will have to be repriced.